Hello guys, and welcome to the second part of the short-term trading pattern series. In the previous installment we looked at basically what short-term trading patterns are, how to interpret them and how they work. In this particular video we are going to be looking at gaps. Basically short-term trading patterns as defined in the previous videos is patterns that we use or that we interpret by using very few number of bars or very little data in order to look at it. It's not necessarily defined by the time frame, but rather by the number of bars that we use in order to make the analysis or do the analysis with. And something that is relatively popular is the general rule that all gaps must be filled. Now, this rule is obviously not true because, as we will see, there are many different types of gaps and many of them are completely meaningless. So in any case, there are, we'll start with sort of defining what gaps are, and then we'll work our way through the four principal types, and then we'll look at some of the more, some of the less meaningful ones at the end. So gaps occur, if a gap is an upward gap, the gap would occur when the low of the current gap is above the high of the previous gap. A gap would occur when the low of the current bar is above the high of the previous bar, and the downward gap would occur if the high of the current bar is below the low of the previous bar. So, as defined by Edwards and McGee in 2007, this hole or void which it creates is a price range in which no shares exchanged hands, right? And that is then our gap. So this gap may or may not have a significance. Generally, gaps that form part of a breakout from a classic pattern, such a longer term price pattern or a trend line, or from a significant support resistance level, could signal the start of a new trend. There are different types of gaps though. Some have meaning, some have not. Gaps usually don't form in market averages, right? So the Dow Jones Industrial Average generally wouldn't have many gaps. The market, because it's not really a tradable instrument, it's a market average. It measures the average of many different instruments, and then as the market opens and things come out of the opening auctions or processes, then the market average or index adjusts very quickly. Index futures, however, so Dow futures, S&P 500 futures, Aussie futures, DAX futures, whatever it is, they do gap because they are tradable instruments. So they gap for a number of reasons. Obviously the significant events, catalysts, or markets opening all over the world. These gaps are basically interpretations of what had happened overnight, and that is built into the price. And we can then use those gaps to give us signals to potentially take trades. So just to show you what a gap looks like, this is a down gap. We can see that the high of this bar is below the low of the previous bar, and we have a large area in between where no shares had traded. So obviously if the gap is up, we see a similar thing to the upside. So starting with the sort of principal or primary types of gaps, there is the first one, which is a breakaway gap. So a breakaway gap generally occurs at the beginning of a new trend and is often the most profitable of all the gaps to trade because it is at the beginning of a new trend. So it gives you early warning that you can get into the trend a lot quicker. So a breakaway gap signals that a pattern is completed or a boundary is penetrated. So we have a longer term price formation, for example, and that price pattern is then broken. Usually with a breakaway gap, that is then a very strong signal that a trend might be forming. So general rule of thumb is the size of the gap is usually proportional to the strength of the subsequent move. The bigger the gap, the stronger the move. Usually in upward gaps, high volume accompanies the gap when it forms. The high volume is not necessarily needed in downward gaps. A general rule when it comes to trading gaps is it's best to wait a short while to see if the initial fading or profit taking of that gap fills the gap, and if it does not, a trade in the direction of the gap with a stop at the point where the gap would fill is probably the best way to trade it. If the price action confirms in the direction of the breakaway gap or in the direction of the gap, the breakaway gap is then a very strong trend signal. If the gap is filled immediately, it might be a good idea, it might be prudent to stop and reverse the trade as the trend is likely to continue in the direction of the gap fill. So to show you a couple of examples, these are we're going to use this particular example again a bit later, but these are basically breakaway gaps where we see we have the market sort of breaking up higher, it doesn't come back, doesn't manage to fill it, continues to trend higher. In fact, we have two breakaway gaps in a row here. We have another breakaway gap, market doesn't manage to fill it, and we have a continuation in the direction of the gap. In this case, we have a bit of a gap down. We have 3 bars of data, forms a 3-bar range, and then we have a break in the direction to close the gap. The gap is then filled eventually, and the market continues to trend in the direction of the gap fill. In fact, we have another breakaway gap in the opposite direction then, in a bullish direction here. So this is a good example of a gap fill that then continues in the direction of the fill, and these are good examples of gaps that then continue to trend, that do not fill, that then continue to trend in the direction of the gap. Right, so a guy called David Landry in 2003 devised a method of mechanizing this breakaway gap, or to analyze it, or to create slightly clearer signals from it, and he called it the explosion gap pivot. So as a definition, the reversal point is often called a pivot. So the explosion gap pivot looks for a pivot low or reversal point where the pivot low is the low of the bar that is surrounded on both sides with higher lows. So this is very similar to the DeMarco-Williams method of finding support and resistance. It's pretty much exactly the same. The difference is that this is following a gap. So the low bar in this case then is the pivot, right? You can also use the Gann 2-day method here, or the Gann 2-bar method, I suppose you would call it in this case, to confirm that this is in fact a DeMarco-Williams low bar or a pivot low. But with Landry's method, you do not need those additional 2 bars of data. For more information on what the Gann 2-day method is and DeMarco-Williams method is, in one of the previous videos we cover that stuff, so please feel free to go have a look. So in any case, to prevent false signals, a breakaway gap must establish a new high for at least the past 20 bars, or 20 days, or bars, depending on the what type of data you're using, and the subsequent retracement must not fill the gap. So if any of these requirements up to this point are not filled or not met, then the gap must be ignored, and we cannot trade it. So if and when the retracement then does occur, and it does not close the gap, mind you, and forms a pivot low, we can then take a buy entry on the subsequent candle or subsequent bar. So it forms the pivot low, right? This next bar, the high of that bar, a breach of that high would then be our long entry trigger or our buy trigger, right? You would then place your stop loss at the lower edge of the gap. And if that gap is then filled, then you would stop and you would reverse the trade. Well, you might not necessarily want to reverse the trade, depending on how risky of a trader you are, but it could potentially be a good setup, because as we've seen, that if the gap is immediately filled, that is usually a good signal that the market will continue to trend in the direction of the gap fill. So if you trade the gap, you get an entry, unfortunately it turns around, stops you out, you might have to then reverse the trade, because that could be the high probability trade. So Landry suggests that you could put your stop just below the pivot low. Other people would suggest that you put your stop at the lower edge of the gap. You will have to mess around with this and see what works best for you. Occasionally the pivot low is pierced, but the gap is not filled, so you might be stopped out unnecessarily, unless you look at different ways of saying if it breaches the pivot low, during the bar, you won't close it unless you have a bar close below the pivot low, then you will close it. But if it touches or just sort of trades at any sort of area, at the gap fill line, then you would close the trade. Something to that effect. You'd have to mess around with it a little bit. So to show you an example, this is actually a explosion gap pivot that works quite nicely here. You can't necessarily see because the chart might be a bit small. But this little red candle or this little red bar here makes a lower low than this green one here, and the green one next to it. So you have higher low, and a pivot low here. So a breach of the top of this would then enter your be your long entry, and for power, as we can see, that worked really well. A bit more detailed, as we can see here, as marked by our little gray line, that is the previous high. We have a gap up and it prints a new high, so it makes a new high for the past 20 days. So we start, is this perhaps a breakaway gap? Yes, it is. So does it make a pivot low? Yes, it does. It breaches the top here. If you are very aggressive, you would have probably not waited for the bar close, so you would have gotten in here. Your stop loss is at the and see, this is where it gets tricky, because if your stop loss is here at the gap edge, then you would not stop out of this trade. If your stop loss was here and you stopped out without confirmation that this bar is closed, then you would unfortunately be stopped out here. If you didn't stop out, if you waited for a bar close before you pull your stop trigger, then you'd still be in this trade. But likely, if you waited for a bar close to pull your stop trigger, you wouldn't get in to the trade on the breach of this long entry. You would probably wait for a bar close to take your long entry also, in which case your pivot low would now be at the bottom of this bar. This would then be, the top of this bar would then be your long entry, and then you would only enter into the trade over here at the close of this bar, regardless of how aggressive you traded or not. As you can see, it trended very strongly in the direction of the gap subsequent to the move, and the gap was never closed. So next type of principal gap that we're going to look at is called an opening gap. So an opening gap occurs when the price for the day is outside of the range of the previous day. So this is very important to note. The opening gap occurs when the opening price for the day is outside of the range of the previous day. So if the prices, the prices in this case may continue in the direction of the gap, and then the opening gap could become a breakaway gap, or price could retrace and fill the gap. Right? So history suggests that with index futures, opening gaps should be faded on large upward openings, as they most often fill during the day. So index futures, Dow futures, S&P futures, Aussie futures, whatever they are, if there's a large opening gap, with those 24-hour stuff, mostly that would probably be in the early hours of Sunday morning or Monday morning or whatever it is, because after the market had been closed over the weekend, if there's a very strong or very large upward gap, then usually those could be sold into, as Kaufman did some research in 1998, shows that more often than not those gaps close during the course of the day. Or if you trade non-24-hour markets like the Aussie, for example, it could be very applicable there. Downward openings, a gap fill is not as common as upward openings in general. This is in relation to index futures only. Note that a gap fill will not occur in a breakaway gap. So if you think it's a breakaway gap and it fills the gap, it's no longer a breakaway gap. If a gap is not filled within the first 30 minutes of the day, so this is an opening gap, so you would likely use 5-minute candle data or 5-minute bar data here. So if the gap is not filled within the first 30 minutes, the odds are that the trend will continue in the direction of the gap, right? So if the market gap's lower and the gap does not fill within the first 30 minutes, chances are the market will continue to trend down. Vice versa on the up as well. So a potential way that we can trade an opening gap is basically to watch the first 3 5-minute bars. So we look for a 3-bar range and we determine the high and low of this range. If we see a breakout of that range in the direction of the gap, then it is likely to trend in the direction of the gap. So if the market gaps higher, we form a range and the range breaks higher, it's very likely that we continue to trend for some time in that direction, which is higher. If the breakout of that 3-bar range is in the direction of the gap fill, it is likely to continue for the gap fill, and then your price target would obviously be the fill line, right? So you'll have 2 price targets here. You'll have the fill line and you'll have the previous day close. The danger here is that I'll explain the difference between the fill line and the previous day close in a moment. The danger here is that the first 3 bars might not form a range, right? So they might just open up and all 3 bars just up. In that case, it's potentially a runaway gap and not necessarily an opening gap. So there's a bit of a difference there. We'll look at a runaway gap in a second. The range for an opening gap must be open. If you're going to trade an opening gap, open, it's got to do a 3-bar range, and it's got to be a very obvious range for you and easy for you to see. So you must also note that a breakout could be false. So if it breaks out, wait for the throwback in the case of an uptrend, or pullback in the case of a down, before entering this. So you might use a narrow range bar break or even a small cup and handle as your trigger here. A narrow range bar break is something we will be looking at later on in this series. Cup and handle is something that we will be covering in a different series, which is looking at longer term price patterns. In every case, it is important to use tight stop losses, obviously because we are doing short term trading patterns here, so tight stop losses are necessary. We know the rules with the stop losses. The gap edge is the stop loss in the case of longs, and in the case of shorts, also the opposite end of the gap edge as well. If the break is in the direction of the fill, the target is the fill line or the previous day close, right? A bounce between the gap and the fill, or the fill line, suggests that the longer term move is likely in the direction of the fill. So if we gap up, trades down to fill the gap, bounces back up to the gap, comes back down towards the fill, chances are that the direction of that, the remaining direction of the day is going to be down towards, in the direction of the gap fill. In the case that, let's say for example, we have a bounce up and a retest of the, sort of a bounce between the fill line and then a retest of the outer extreme of the 3-bar range, then it is likely that the trend for the remainder of the day is going to be in the direction of the gap. So to visualize this, let's say you have a gap up, it comes down, closes the gap. Gap up forms a 3-bar range. In that 3-bar range, obviously pushes slightly higher, forms a 3-bar range, fills the gap, and then bounces all the way back up to the very top of the 3-bar range, and then breaches that. Chances are it's going to be an uptrend for the day. So to give you an example, here we have, it's very compressed data because this was a colossal move, but this, we can see we marked off the high of the previous day here, and the opening price here was outside of the trading range of the previous day. So we mark off this as our fill line because that is the high of the previous day. Now remember, if you use daily data, it's that you use the highs and the lows of that whole day. So with an opening gap, you're now using 5-minute data, but you're still using the highs and lows of the days, right? So in this case, we have the opening gap. We form a 3-bar range. We have a breakout in the direction of the gap. It makes a bit of a throwback. It gives us a nice break above this this level again, and we can then trade in the direction of the gap. So to explain the two other sort of really confusing things just a moment ago, if we see this 3-bar range break down towards the direction of the gap, obviously our target is this fill line as a first target, and the second target would be the previous closing price, which I haven't marked off here, but that would be 177 in this case. So that would be your first target, that would be your second target, right? If we see a move back down to the fill line and then a bounce up and then a move back sort of towards the fill line, chances are we're going to trend down for the rest of the day. If we break this 3-bar range down and then bounce all the way back to the top of the 3-bar range, then the chances are very strong that we're going to continue to trend up for the rest of the day. Okay, if that doesn't make sense, please ask questions, join the Discord. You'll see in below there's links for the Discord. Leave comments, ask questions, do whatever, and we will be happy to help you and explain in some more detail. So the next type of gap that we get, or the next two major ones of the 4 principal ones, is a runaway or measuring gap, and the last one is then exhaustion gap. So looking first at the runaway gap. The runaway gap occurs along a trend, and it's called a runaway or a measuring gap. It usually occurs when there's a very, very strong trend in place with very, very few corrections. The sort of market just picks a direction and it just goes and it doesn't stop. It's called a measuring gap because like a pennant or a flag, which is a longer term, both longer term price formations, they usually happen, in the middle of the price run. So we could usually then, because it's called a measured gap, we can measure the move into the gap and use that same sort of distance as a price target on the way out. So in 2010, Bolkowski did a lot of work around this and found that with upward runaway gaps or measuring gaps, they usually occur 43% of the distance from the beginning of the trend to the eventual peak, right? So it's just under halfway up. As we're with a downward runaway or measuring gap, they occur generally 57% of the distance between the beginning of the trend and the eventual trough. So again, around the halfway mark on the way down. So this is quite a nice sort of thing to keep in mind if you see a runaway gap or measuring gap, that you should see, okay, we're maybe about halfway through this move now, so I can be patient and stick it out. And these actually work very well, guys. Exhaustion gap occurs at the end of a major move. And people often confuse exhaustion gaps or runaway gaps or the explosion gap pivot for an exhaustion gap, because they could have very, very many of the same characteristics as the previous ones, right? So a breakaway gap feels and looks very similar to an exhaustion gap, except an exhaustion gap very quickly fills the gap. So an exhaustion gap basically looks and feels exactly like a runaway gap, or potentially even a breakaway gap, but the market fills that gap very, very quickly, and that could then potentially signal to us the beginning of a correction or a consolidation or a potential trend reversal. So to show you, this is as we showed here earlier, this was a breakaway gap. In fact, this was a explosion gap pivot or a breakaway gap, but it is also, if you look at this, a runaway gap, because we have a long trend here, and yes, this is a breakaway out of a what could have been a sort of a flat top triangle. It is a breakaway, but it is also a continuation of a longer trend and looks like a runaway gap as well. So you can see that they're kind of very similar, not necessarily always. And then these obviously are runaway gaps or measured gaps as well, or measuring gaps as well. The movement into this gap is the movement out. The movement into this gap is the movement out, and this actually trends very, very strongly. Then some of the less important ones that we can generally ignore. You get minor gaps or common gaps, which occur very frequently in illiquid stocks. So there aren't, there's less than 200,000 shares that trade a day. This thing's not very liquid. So you sometimes have gaps, particularly in short-term data, 1 minute charts, 5 minute charts. The thing only trades every 3 hours. It forms gaps. Those can obviously, they have no meaning. They're inconsequential. You can ignore them. Pattern gaps usually occur within the formation of a larger price pattern, and they're generally filled. The only significance that they have is they show that congestion areas are forming. Ex-dividend gaps sometimes occur when stocks, go ex-dividend. So the dividend, it was the last day to trade, the next day is ex-dividend, so the price of the stock adjusts lower in order to compensate for now the reduced value, because it no longer has the dividend value in it. And these are very, very often confused because we don't necessarily always do our homework, and we think, wow, there's a huge gap here, this could potentially be something meaningful. Meanwhile, it's actually absolutely meaningless because it's an ex-dividend gap, and we must be very careful to not to misinterpret them as anything different. Very, very, very rarely there can be opportunities for gap closes, but only under very specific circumstances, if the entire market and all the stars are aligned for the overall trend for the entire sector even is in the direction of the gap fill, then they could have a potential opportunity for us to close that fill. But even so, they're not necessarily reliable, so we might potentially see them as an opening gap, but an ex-dividend gap and opening gap is not the same, so don't confuse them as the same. Then a suspension gap is often formed in 24-hour futures contracts, where those contracts trade on 24-hour exchanges, and one market opens, another one closes, and there's like a short period where there's very little liquidity, 30 minutes or 20 minutes or 5 minutes or 2 hours or whatever the case is, where the two markets sort of overlaps and one opens, one closes. Then there could be gaps in these 24-hour futures contracts, and for the most part they are meaningless unless they have some of the characteristics of the four principal ones we described slightly earlier. And that brings us to the end of analyzing gaps or understanding gaps as part of the short-term trading pattern series or short-term pattern series. We are going to be doing videos like this every week. Next week we have more content for you, so please come back, please subscribe, please hit notifications, hit the bell, join us in the Discord, leave comments, ask questions. We are here to help.